Welcome to the deep dive. Today, we're really getting into the weeds with POWERGRID Corporation, a major player in India's power sector. We've got their latest board meeting decisions from November 3rd, and maybe more importantly, their half-year financial results up to September 30th, 2025.
That's right. And our goal isn't just, reading out numbers. We want to understand the strategy underneath. What are these moves signaling? We're seeing a company, I think, really gearing up. Maybe preparation is the theme. Preparing for future needs with new funding, preparing for efficiency with some big internal changes, and, well, prepared to give back to shareholders right now.
Preparation. I like that. Okay, let's start with the most immediate thing, the shareholder return. That November 3rd board meeting approved an interim dividend, yeah.
They did. The first one for this financial year, 2025-26, it's set at 4.50 Vir per equity share.
Okay, 450, and the face value is 10 rupees, so that's, what, a 45% payout?
Exactly. 45%. It's a solid signal, shows confidence in their cash flow and commitment to, steady returns for the people holding the stock.
And predictability is really what you want from a company like this. The sources also gave us dates, didn't they?
Yep. Clear timeline. Record date is November 10th, 2025. And the actual payment should hit accounts around December 1st, 2025. So pretty immediate.
Right. But dividends are only one side of the coin. They also need capital for growth, for that preparation you mentioned. What about funding?
Yes. At the same meeting, the board also gave the green light to raise more debt, up to 6,000 crore.
6,000 crore, that sounds like a lot. How does that stack up against their existing debt?
It is a big number, definitely, but you have to put it in context. As of September 30th, their standalone total borrowings were already massive. We're talking over 1,035,000 crore.
Wow.
So
Yeah.
this 6,000 crore, it's more fuel for the engine. They're constantly building power lines, substations, all that infrastructure. That's their capital work in progress, the CWIP, and it needs continuous funding. This loan, specifically an unsecured rupee term loan or line of credit from SBI, is key for that.
Shows they're planning ahead. Now, did the sources say anything about how they used previous funds they raised? Are they spending it as planned?
Good question. And yes, the documents are pretty clear on that. They raised 2,000 crore through bonds, non-convertible securities, back in the first quarter. That's fully utilized. Then they raised another 5,000 crore in the second quarter. Out of that, about 1,850 crore has been used so far.
And importantly,
the report explicitly states there's been no deviation reported in how they use those funds. They borrowed, they spent it on what they said they'd spend it on. That's crucial for keeping trust, especially with lenders and the regulator.
absolutely, that transparency matters. Okay, let's pivot now to the actual performance. The financials for the first half of 2025 ending September 30th. We should probably start with the standalone results first, right? Just the core business.
Yes, exactly. Standalone gives you the picture of their main job, transmitting electricity. Before you factor in all the subsidiaries and joint ventures, it's the core engine.
So how did that engine perform revenue-wise in the first half?
Well, revenue from operations was pretty stable, but actually dipped slightly compared to last year. It came in at around 19,927 crore, down just a bit from 20,328 crore in H1 2024.
Okay, a small dip in core operational revenue, but then the total income number actually went up, didn't it? To over 22,600 crore. How does that work?
Oh, that's the interesting part. The difference, the thing that pushed total income up, was a really significant jump in other income.
Other income.
Yeah, it surged to nearly 2,700 crore compared to about 1,900 crore in the same period last year. That more than made up for the slight dip in operating revenue.
So what counts as other income for a huge utility like POWERGRID? It's not like they're selling merchandise, right?
Oh, no. Typically, for a company like this, other income often includes interest they earn on their cash reserves, maybe some income from consulting. But very often, it also includes specific income recognized based on regulatory approvals. Think of things like deferred revenue allowed by the regulator, the CERC, or specific returns on equity components. It shows their financial management and how the regulatory system works to ensure stability.
Okay, so the core transmission was steady, maybe slightly down, but financial management and regulatory income boosted the overall top line. Got it. How did that flow down to the bottom line, the profit?
Profit basically followed that total income trend. Standalone profit for the half year ticked up slightly to 7,208 crore from about 7,123 crore last year.
And earnings per share.
EPS also saw a small increase, up to 7.75 from 7.66. But there's a small note there. The authorities mentioned this EPS includes regulatory deferral balances.
Right. Regulatory deferral balances. Can you unpack that quickly for us? Why include that in earnings?
Sure, it's a feature of utility accounting. These are costs the company has already incurred, but the regulator, C, has agreed they can recover them from customers through tariffs in the future. So, accounting rules often allow them to recognize this future recoverability now to smooth out earnings and reflect the long-term regulated nature of the business. It's essentially pre-approved future income.
Makes sense. Stability again.
Yeah.
Okay, shifting gears slightly with all that debt we talked about, how healthy do they look in terms of managing it? Liquidity, solvency.
That's where the ratios come in, and they look pretty solid. First, let's look at short-term liquidity. Their standalone current ratio improved. It went up to 0.95 from 0.79 a year ago.
Okay, 0.95. Still below 1, but moving in the right direction.
Exactly. It means their current assets are getting closer to covering their current liabilities. Better working capital management.
And the really critical ones for debt, the coverage ratios. How are they doing there?
Very strong. There are two key ones. First, the interest-service coverage ratio, ISCR. That measures how easily their operating profit covers just the interest payments on their debt.
And the number?
It's 3.87 for the half year. So their earnings before interest and tax were almost 4 times what they needed just to pay the interest. That's a comfortable margin.
Okay, very comfortable. And the second one?
The debt service coverage ratio, or DSCR. This one's broader. It looks at their operating cash flow against all their debt obligations for the period principal repayments plus interest.
And that was?
1.33 for H1 2025.
So 1.33 means what exactly in practical terms?
It means for every 1 rupee of debt obligation they had, principal and interest, they generated 1.33 rupees in operational cash flow to cover it. A DSCR above 1.0 is essential. Being at 1.33 gives them a significant cushion. Lenders love to see that. It means they can handle some bumps in the road without missing debt payments. That's why they can confidently go out and borrow that extra 6,000 crore.
Right, that buffer is key. Okay, that's the standalone picture. Now let's zoom out to the consolidated view, the whole group, including subsidiaries and JVs. Where's the strategic action happening there?
Well, transmission is still king, no surprise. Consolidated transmission revenue was over 21,400 crore for the half year. Dominant. But the really eye-catching story, I think, is in the consultancy segment.
Ah, yes, I saw that number. It looked like a huge jump.
Huge is right. Phenomenal growth, actually. Consultancy revenue absolutely rocketed up to over 1,020 crore in H1 2025.
From what, last year?
From just about 378 crore in H1 2024. So it's nearly tripled year on year. A massive proportional increase.
Wow, that's clearly not just organic drift, that's a strategic push. What does that tell you about their direction?
It tells me they're successfully monetizing their expertise. They're not just building and running lines for themselves. They're selling their know-how, project management, planning, execution to others, maybe in India, maybe internationally. It's less capital intensive than building physical assets, diversifies their revenue streams away from just the regulated transmission business. It seems to be a real growth engine for them.
So, stable core, high-growth consultancy arm. Makes sense. Now, underpinning all this seems to be some major internal restructuring. The sources mention a really complex merger scheme involving lots of subsidiaries. Why go through all that effort?
Well, that's quite the undertaking. And they're basically trying to streamline things. They have numerous smaller subsidiaries, often set up for specific projects like POWERGRID Kavda 11B or Dram Jagar Transmission. The plan is to merge many of these into just 2 larger transferee companies, POWERGRID Kavda Type Transmission Limited and POWERGRID Vadam Transmission Limited.
Okay, but why consolidate? What's the benefit? Fewer names on the letterhead.
Well, yes, but it's more about efficiency. Think about it. Every single one of those subsidiaries needs its own separate set of accounts, its own regulatory filings, potentially its own tariff petitions with CERC. Merging them drastically cuts down on administrative overhead, simplifies governance, makes managing capital across related projects much cleaner. It's internal housekeeping, but on a grand scale, aimed at saving costs and time.
Makes sense. And where is that process at legally? Is it done?
Not quite yet. It's ongoing. They filed the second motion petition back in July 2025. The Ministry of Corporate Affairs, the MCA, had a hearing on it in mid-October. They're still waiting for the final order from the MCA, so it's in the final stages but not officially complete.
Okay, so major internal consolidation moving forward. And at the same time, they're also doing some external pruning, selling off stakes in some joint ventures.
That's right. They've got in-principle board approval to sell their stakes in a few JVs. Torrent Power Grid Limited, which actually stopped being a JV back in May 2025 anyway, plus Sikkim Power Transmission and Parvati Koldam Transmission Company.
And the strategy there is?
It seems like classic portfolio optimization, shedding smaller or perhaps non-strategic investments to free up capital and management focus. Allows them to concentrate resources, like that new 6,000 core loan, on their core transmission build-out and that fast-growing consultancy business, tidying up the edges.
Right, focusing the firepower. Now, one last check back on the debt side, specifically for the bond investors. What about security for their listed non-convertible debt?
Always important for debt holders. The documents confirm they're maintaining the required security cover. It's certified at 1.10 times the book value of the assets secured against that debt.
Is 1.10 times considered good or just meeting the requirement?
It meets the regulatory requirement, which is the main thing. For a stable, regulated utility like PowerGrid with predictable cash flows, meeting that 1.10 else is pretty standard. Honestly, for lenders, the real comfort likely comes more from those strong coverage ratios, the ISCR and DSCR. We talked about the proof they generate enough cash, not just that the assets have value on paper.
Okay, so wrapping this all together then, what's the main takeaway for someone trying to understand PowerGrid right now?
I think the key takeaway is you've got a company with a stable, profitable core transmission business. The financial health indicators, especially around debt management, look robust. And, critically, they're actively preparing for the future. They're securing new funding for growth, undertaking complex but necessary internal mergers for efficiency, and strategically selling off non-core assets. It's a picture of stability enabling strategic action.
Okay, so here's a final thought for you to consider. We mentioned that huge investment base, property, plant, and equipment, plus the capital work in progress totals over, what, 2,011,000 crore on a consolidated basis? Just immense. The big question going forward is how that new Euro 6,000 crore loan, combined with the eventual completion of those big internal mergers, will actually impact the pace and direction of that massive capital program. And remember, all their future returns on these investments are now going to be determined under the brand new CERC tariff regulations from 2024. So how effectively this preparation phase, the streamlining, the new capital sets them up to maximize returns under those new rules. Well, that's really the story to watch unfold in the coming years. Thanks for joining us for The Deep Dive.